Hello and welcome. If you've been keeping an eye on the housing market, you know it's been, well, let's just say it's been frozen solid. But some major news just hit that could finally signal the beginning of a thaw. So let's get into it and break down what this all really means. So here it is. This is the number that has the entire real estate world talking. For the first time since way back in August of 2022, the average rate on a 30-year fixed mortgage has officially dipped below the 6% mark. Now that is a huge psychological line to cross. But the real question is, what does this actually mean for you? Whether you're a homeowner who's felt completely locked in by your amazing low rate, or you're a buyer who's been patiently waiting on the sidelines, this could really be a game changer. Look, we've seen rates dip before, right? Only to watch them shoot right back up again. So the big question on everyone's mind is this time actually different? Well, a lot of experts seem to think so. They believe this drop might just have some staying power. And that word right there, sustainable, that's everything. What Matthew Graham from Mortgage News Daily is getting at is that this isn't just some random, fleeting dip like we saw last year. The economic forces behind this drop feel a lot more solid, which suggests these lower rates might actually stick around for a while. So, what is actually causing these rates to fall? I mean, it's not magic, right? It's a direct reaction to some really big things happening in the wider economy. Let's connect the dots here, because it can seem complicated, but it's not. It really starts with the stock market. When stocks sell off, nervous investors pull their money out and they look for a safer place to put it. And that safe place is often the bond market. So when everyone rushes to buy bonds, the return you get on them, the yield, goes down. And here's the crucial part. Mortgage rates are super closely tied to those bond yields. So when bond yields fall, mortgage rates follow. You add in the fact that inflation is finally starting to cool off and a GDP report that was a little weaker than expected, and boom, you've got the perfect recipe for lower mortgage rates. And boy, are people already reacting. This number is just wild. Applications to refinance a home loan shot up 132% compared to the same time last year. That tells you that homeowners are jumping on this as a real chance to lower their monthly payments. But what about selling? And that brings us to this really key idea that economists are talking about. They're calling it the unlocking effect. And honestly, it could be the very thing that finally starts to thaw out this frozen housing market. This is the million-dollar question, isn't it? I mean, for the last couple of years, millions of homeowners sitting on these incredible 3%, even 2.5% mortgage rates have felt trapped. Why would they sell? It would mean giving up that amazing rate for a much, much higher one. But as these new rates start to come down, that math starts to change. To put it really simply, here's how Realtor.com's senior economist Jake Kreml explains it. The unlocking happens when the gap between your current super low mortgage rate and the new rate you could get today gets small enough that moving doesn't feel like a financial disaster anymore. And this little comparison makes it crystal clear. Just think about two different homeowners. On one side, you have homeowner A, who scored a 3% rate. For them, the jump to 6% is just massive. They're locked in tight. But then you have homeowner B. Maybe they bought or refinanced a little later and their rate is more like 4.2%. For them, the jump to 6%, yeah, it's still an increase, but it's way more manageable. It doesn't feel like jumping off a cliff. They are the ones who are most likely to be unlocked by this rate drop and finally put that for sale sign in the yard. Okay, so this whole unlocking thing is a great theory, but where might we actually see it happen in the real world? Well, the data is starting to point to some pretty specific places. According to Realtor.com, these are the metro areas to keep a close eye on. And you might ask, why them? Well, it's because in cities like Detroit, Cleveland, and Dallas, the typical existing mortgage rate for current homeowners is a little bit higher, somewhere between 4.1 and 4.3%. And that means a bigger chunk of their population is just like our homeowner B. The gap to a new 6% rate is smaller, making them much more likely to make a move. But here's where it gets interesting. Even within this list of unlock markets, the effect is going to play out very differently depending on what's happening locally. So let's just take two of those cities as an example, Cleveland and Dallas. So in a more affordable market like Cleveland, the interest rate itself has been the biggest obstacle. A drop of just a single percentage point can make a huge difference in what people can actually afford. It could be the push that a move-up buyer needs to finally sell their starter home, which then, and this is great, opens up more inventory for first-time buyers. You get this positive ripple effect. Now, let's contrast that with a place like Dallas. A lower rate definitely helps, but the much bigger problem there is just a severe lack of homes for sale in the neighborhoods everyone wants to live in. As Harrison Polsky points out, sellers are really hesitant. Sure, they might get a fantastic price for their house, but they're terrified that they won't be able to find anything to buy back into in that same area. So here, the problem isn't just the rate, it's the supply. Okay, so let's put all the pieces together here. What's the big picture? Are we finally seeing the beginning of the end for this deep freeze in the housing market? All right, so let's recap the most important takeaways. Number one, rates dipping below 6% is a massive psychological win. It just feels different. Two, this whole unlocking effect is all about the math. How small is the gap between someone's old rate and a new one? Three, we should probably be looking to markets in the Midwest and the South to see the first real signs of this thaw. And finally, and this is so important to remember, this is going to be a slow, gradual process. Don't expect a sudden flood of new listings overnight. And really, that's where we'll leave it. This rate drop to 5.99% is so much more than just a number. It's a potential catalyst for real change in a market that's been stuck for years. The big question for all of us to watch now is this that first little crack that eventually breaks the ice? Thanks for watching.